The central bank has reduced the policy rate by 200 basis points from 20% to 18%. The latest rate is one of the lowest recorded in Ghana's economic history. A reduction in the risk to inflation and a general improvement in the economy are factors that fueled the reduction. The policy rate is the rate at which the Bank of Ghana lends to commercial banks.
The policy rate is the rate at which the Bank of Ghana lends to commercial banks. A drop in the rate means a drop in lending rates to banks, resulting in reduced lending rates to customers. The converse is true. Since the beginning of 2017, the policy rate has consistently trended down from 25% in 2016 to 20% and now at 18%. The governor of the central bank, Dr. Ernest Addison, mentions the current disinflation as a justification for the reduction.
Our latest forecast suggests that the medium-term inflation target of 8 plus or minus 2% is within the forecast horizon, and we are on course to meeting the inflation target band. The committee noted that the current inflation forecast provides scope for monetary policy to realign interest rates, translate the disinflation gains achieved so far to the market, and reinforce the fiscal consolidation process by easing the burden of interest payments on the budget. Under these circumstances, the committee decided to reduce the monetary policy rate by 200 basis points to 18%.
Inflation has dropped consistently from a high of 15.5 or 15.4% in 2016 to the current 10.3%. Analysts are expecting a resultant reduction in interest rate from the banks, but the banks blame their inability to respond to the decrease in policy rates to the risk in the market.
In our earlier bulletin, the head of the economics department of the University of Ghana, Professor Peter Korte, spoke to us about the implications of the policy rate reduction on the economy.
If you look at the reports that the bank churned out recently, it clearly shows that growth momentum has picked up. It also showed that inflation expectations is quite within acceptable limits. Exchange rate stability has been relatively stable, and so based on this, the bank thought it should reduce the policy rate, which is in line with government policy of stimulating the private sector. When the cost of credit is reduced, the private sector is able to borrow, is able to produce and enhance output and employment hours.
And would you say we have the necessary structural reforms, such as ID cards from the banks, to respond to the reduction?
Well, the banks have, in the past, when the rates are reduced, have been very sticky. We think it is sticky downwards. Their response has been very sticky. But when the rates are reviewed upwards, that is where they also increase their rates. But of late, we've seen, based on recent Bank of Ghana reports, that the interbank rate being reduced, they reduced from 19% to 18.3%. Seen some positive response from the bank. I believe they have the necessary in place to ensure that this reduction transmits into the monetary policy rates or the market rate that they are involved with. The central bank is working closely with the financial sector, the banks especially, to have a formula for computing the base rate. When that is done, it will be very transparent. They will be able to know what actually feeds into the determination of their interest rates. And therefore, anytime the policy rate is reduced, we know with certainty which they can also, or they have to reduce or increase their rates because the policy rate. Well, if they do not respond, we are in a system where we use market operations. We've gone out of the system controlled regime. So moral suasion be one option. To the bank have a discussion with the commercial banks to ensure that they respond. But when this new formula for computing interest rate is in place, then it becomes much easier for the central bank to enforce whatever directive they put across, because then you can conveniently compute the effect of the policy rate reduction on money market rate, so the bank can then boldly and transparently force it.
What will be the overall impact on the economy generally?
The impact will depend how banks respond, how the interest rate respond, the market rate. I believe they will respond favorably. If they do, then the cost of credit with all of us would come down. That can make investment, that can stimulate output, and can lead to some level of employment within the country.